Welcome back to the Money Wisdom Podcast, powered by Johnson Bernetti. My name is Jake Dozer. I'm a certified financial planner and advisor here on the team in Connecticut, joined, of course, by Nick Colantuno. Nick is also a certified financial planner and an advisor on our team in Massachusetts. Today, we've got a question in front of us that we want to talk about, and it's all about how do I avoid the tax trap that comes in retirement? I think it's important first, anytime that we're talking about these things, what is this tax trap? I think about that Star Wars meme, if you've ever seen an image, it's a trap. And certainly taxes can be a trap in retirement. I think, to define these terms, a tax trap in retirement is the fact that everyone has this misconception or this general rule of thumb that, in retirement, I'm not going to need as much income, and so my taxes will be lower. And then from there evolves out all these ideas of how you invest your money. And most folks invest their money in their 401k at work or 403b or 457, whatever workplace retirement account you have at your employer. And what they do is they do the default setting. What's the default setting? Deferring their taxes until later. Well, if your taxes are a lot lower in retirement, that might work out, but it doesn't prepare you for flexibility. Nick, maybe you can elaborate a little bit more on this tax trap, this common rule of thumb that a lot of times we see so many people fall into that sort of traps them to where they have nowhere to escape in the future when taxes might go up or they need large amounts of income. I don't want to spoil too much. Go ahead.
Well, look, there's just a lot of unknown, Jake, and you hit the nail on the head when you said that there's this misconception, right? The old saying is don't pay taxes when you're in your high earning income years, save the money for a rainy day, get the benefit of the tax deductible contribution into the 401k or in the IRA. Don't pay the taxes now when you're in your high earning income years, your high tax bracket years. Take it out 10, 15, 20, 30 years from now when you're going to be in a lower tax bracket. You know as well as I do, push comes to shove, the rainy day is here, and most of the folks we're working with, they might be 10 plus years into retirement, no longer working, no longer saving, yet all of a sudden they find themselves in the highest tax bracket they've ever been in.
Yes.
And it's that, right? That idea there is the tax trap. And people say, well, Nick, what do you mean? I did what I was supposed to do. I saved into the 401k or I saved into the pension. And sure, my earned income is lower because I don't go to work and I don't get my paycheck. But guess what? My bills are the same. And you still need to make up the difference between what's coming in and what's going out. And if there's no paycheck from an employer to cover what's going out, well, that's where a lot of our clients need to start paying themselves. And as you mentioned, the easiest way or the most common way people pay themselves are from these accounts that they've never paid a penny of taxes on in their life. So that is the essence of it. That's the essence of the tax trap. And what's the problem there? Well, the problem there is a lot of our clients, when they're in those retirement years, now they're collecting Social Security. And a lot of people are surprised, I owe taxes on my Social Security.
Right.
Well, yes, Social Security, your taxes are based on your other sources of income. And if all that money is being funneled from these IRAs or 401ks, where, as I mentioned, you never paid taxes on it before, well, all of a sudden you might have gone from a position where you didn't owe any taxes on your Social Security to now you might owe taxes on 50%, maybe even 80% of that Social Security benefit.
Right.
So obviously that's something that people need to be aware of. It's the take home that matters. And that's where, taxes are everything.
Yeah, that's exactly right. So, there's two people listening today. If you're that person who is in their early mid-50s, you're ahead of the game. You're thinking about, as I'm winding down my working years, it might not feel that way, but when you're in that 10-year off-ramp from working, transitioning into retirement, you're in the phase of life where you're about to start using this money that you were told your whole life not to touch, right? And so to that person, what I would say is general rules of thumb are kind of behind you at this point. In your 30s and your 40s, and if you're making a lot of money and you want to defer your income because retirement's 20 or 30 years away, okay, that's fine. You're not close enough yet to retirement to really understand what type of income you're going to have and need. And so basing your decision making on general rules of thumb is a good idea. But when you're 10 or so years from retirement or less, you're close enough to start making much more specific decisions unique to your circumstance. And so all of a sudden, you need to flip the script and say, I'm no longer deferring all of my income till later. And now I'm having a conversation year by year under the construct of tax planning, not just avoiding taxes today, but saying from now until the time I pass away, when is the right time for me to write the check so that I write the smallest check, right? The goal is not to defer in perpetuity, because that just means you're deferring the problem till later. That's like burying your head in the sand. And let's face it, that's really only good for ostriches. It's not good for people. So let's start addressing it. Maybe that means you pay some more taxes now, so you pay less taxes later. I don't care when you write the check. I just want the check to be the smallest. And then the second group of people are those people who are in the throes of retirement. Now you're boots on the ground, left with hopefully not a mess, but perhaps the mess that you created, which is, did I defer all of my income into this new stage of life where now I'm told to live off of this 401k forever? And now I have nowhere to hide because all of my income is taxable. Because as Nick mentioned, you've got your Social Security check, and if that was it, it wouldn't be taxed. But of course, you're probably going to have interest tax from the bank. You're going to maybe have some dividends from some stock. And then you withdraw from your IRA and you pay taxes. And so let's make sure that we have the flexibility through proactive planning to determine when to write the right check so that it's the least amount. If you're in this situation where you'd like to take this concept and really make the rubber meet the road and understand where it applies to you, you should reach out to us. I've got some information here. It's all about our Are You Paying Too Much in Taxes booklet that we have. So if you text the word offer, OFFER, to 800-757-0436, we'll send you this book about Are You Paying Too Much in Taxes? Again, text the word offer to 800-757-0436, or simply give us a call at that number, 800-757-0436. We'll schedule a time for you to come into the office, and we'll look at your circumstance and figure out where are you at, where do you need to be, what kind of income do you need to create, and how do we pay the least amount of taxes along the way. That's something that we're talking to folks all the time about when we're providing a complimentary consultation or working with our clients on an ongoing basis. So, Nick, we talked about what this tax trap is. We talked about the things that folks who are yet to retire need to be thinking about. We talked about how we need to think about it if we are in retirement. But if we're beyond this phase where we're thinking about where we're adding money and what the tax implications are later, talk to us about the backside of that coin. Talk to us about Roth Conversions, which is one of the other big levers that we can control how we're paying taxes and when.
Sure. Yeah, it's a fantastic point. And Jake, I give you credit for this. You always make me try to make clients aware of aligning purpose to dollars. And, when we're having these conversations about Roth conversion planning, oftentimes, sure, it means that our clients over their life will pay less in total lifetime taxes and probably accumulate more money because now it's growing in a tax-free world. But I find the real reason that we're doing these Roth conversion plans for clients, it's because of the way that money gets left behind. Mm-hmm. So legacy is certainly a large part of it. And for those of you listening who might not be aware of the tax implications of leaving money behind, whether it's in an IRA versus a Roth or a brokerage account, brokerage assets, real estate, stocks, cash in the bank, all that sort of stuff, that you get stepped up cost basis on those assets. So pretty efficient to leave it behind. IRAs, 401ks, 457s, right? The tax deferred retirement accounts. The new rule is if you die and you leave that money to anyone other than your surviving spouse, so think kids, grandkids, nieces, nephews, people you care about, they have to withdraw 100% of that money over a 10-year period after the date of your death. So being able to maximize legacy, I always try to get people thinking about, well, if you're leaving that money to your kids in a retirement account, it's probably going to coincide at a point where they're in their highest earning income years. Right. 10 or 15 years from now, where tax rates could be twice what they are right now. So point being, you're going to be lucky if they walk away with half of it. And, a lot of people say, well, good problem for them to have, but it could be a problem nonetheless. So if you have an objective of leaving money behind, we want to make sure that you're doing that in the most tax efficient way. And that's often where those Roths come into play. And people always will then say, well, if I'm doing a Roth conversion, do I have to leave that money behind? No, you could take that money out tax free, and you can get your hands on that tax free whenever you want. So it just provides people with a lot of flexibility and a lot of control, not just from a legacy planning standpoint, but really from a cash flow planning standpoint in retirement, because that's what it's all about. Retirement income planning. I want people to think about it more like retirement cash flow planning, because anytime you have income, you have taxes. But cash flow is a whole different element. We're in the business of now helping our clients kind of unwind this big ball of wax that they've been accumulating for 30 plus years. And how do you now replace your paycheck in a way where you're not blowing yourself up from a tax standpoint while doing it? So it's all about diversifying, not just diversifying from an investment standpoint, diversifying your accounts across different tax classes. Because if we know, what you need coming in, and we know what's going out, and we know what the difference is, you also need to know that you have flexibility and control over where that cash flow, right, where that income is coming from, and what the implications of it are.
That's right. There's so many moving pieces with this conversation. Avoiding the tax trap is all about getting ahead of taxes. It's about choosing when to write the right size check so that overall your money, whether it's used by you in your lifetime or your heirs, is taxed the least, and Uncle Sam isn't left with a tip. Hopefully today's Money Wisdom podcast episode has been helpful. If you're tuning in on YouTube, we appreciate your support. Give this video a like. Be sure to subscribe. If you're listening on wherever you listen to your podcast for audio, give us a subscribe. And be sure to send us your comments or questions, and we'll make sure that we'll cover them in the upcoming videos. We'll see you next time.
Investment advisory services offered through JB Capital LLC. Insurance products offered through JN Financial LLC.